Okay, so we have seen that in a perfect world, the firm's capital structure doesn't affect the firm's value. In other words, as M&M proposition 1 says, VL equals VU. Okay? Well, another way to put it is to put it in terms of the firm's overall cost of capital or overall expected return. Okay, so we can think of a levered firm as a portfolio of equity and debt. And as we have seen from the previous mathematical proof, holding this portfolio of levered firm generate the same cash flows as investing in the otherwise identical unlevered firm. Therefore, the expected return of the portfolio of holding the levered firm should equal the expected return on the unlevered firm. And as we have learned from chapter 13, the expected return of the portfolio of equity and debt is simply summarized by the firm's WACC, weighted average cost of capital. Therefore, the proof that we have seen before says that the levered company's WACC, the expected return on a levered company, should equal the expected return on the unlevered company. So thus, we can write the following equation. So let's say that we use the notation RU for the expected return on an unlevered company. Okay, so it's expected return on an unlevered company. And then the proof from the previous mathematical proof says that expected return on the levered firm, which is summarized by its WACC, should equal RU. Okay, and WACC equation goes like this. So we have equity weighting E over value times expected return on equity RE, which we could have measured using model like CAPM, right? And then we have debt weight, which is D over V times expected return on D, RD. The actual WACC equation has 1 times corporate tax rate next to RD, but remember that we are living in a perfect world where tax doesn't exist. Therefore, this 1 minus tax term disappears in this perfect world. So we call this pre-tax WACC. So in a perfect world, the levered company's WACC is represented by the pre-tax WACC, and that should equal RU. It means that no matter how the company mixes its debt and equity, the firm's WACC will not be affected, and it will always remain constant at the level of RU if the world is perfect. Okay. Then from this equation, we can rearrange the equation in terms of RE. Okay, so in terms of representing the equation in terms of RU, we can rearrange the equation in terms of RE. After a little bit of work, we can arrive at this equation. So this is just nothing but a rearrangement of the previous equation. So the rearranged equation says RE, the expected return on equity of the levered firm, should equal RU, the expected return on unlevered company, plus D over E times RU minus RD. So this is the M&M proposition 2, okay? So what does the M&M proposition 2 say? So basically it says, although in a perfect world, although the total firm value and overall cost of capital or the expected return on the total asset of the firm is not affected and remain the same, but expected return on the firm's equity is affected by the firm's capital structure shows even in a perfect world. And there is a very specific relationship in terms of how capital structure affects the return on equity. Okay, and the proposition, M&M proposition 2 equation is characterizing the relationship. So in other words, even in a perfect world, expected return on equity will increase with the leverage, which is represented by the firm's debt to equity ratio. Recall that, note that now the capital structure ratio is represented by debt to equity ratio in terms of debt to value ratio. So when the firm is unlevered, so it's not using any debt at all, this term will disappear. So the levered firms, the firm's equity cost of capital or expected return on equity will the same as RU. But as the company starts using the amount of debt, the expected return on equity will increase monotonically and proportionally to the firm's capital structure, represented by its debt to equity ratio. And the speed of the increase will be determined by the spread between RU and RD. So summarizing once again, M&M Proposition 2 says the expected return on levered company's equity, represented by RE, notation RE, is equal to the expected return on unlevered equity, RU, plus a premium that is proportional to the firm's debt to equity ratio. And the rate of increase depends on the spread between the expected return on unlevered equity, RU, and the expected return on RD. If that is too confusing or complicated to understand, let's draw a chart. A graphical image will much more helpful in understanding the relationship. So imagine a space where we have a debt to equity ratio on an x-axis, and we have a bunch of different expected return on the y-axis. In a perfect world, there's no cost of financial distress or cost of bankruptcy. Therefore, RD will remain constant across all levels of capital structure ratios. So no matter how the firm's debt to equity ratio changes, RD will remain constant. But even in a perfect world, as the debt to equity ratio increases, according to the M&M Proposition 2, expected return on levered company's equity, RE, will monotonically and proportionally increase. And the speed of growth or speed of increase will be determined by RE minus RD. Well, so now there's a trade-off. Well, due to the nature of a contracting, debt contracting is safer than the equity contracting, as we have learned from chapter 14 and 15. Debt holders receive the promises and guarantees in terms of the cash flow they will receive, but equity holders don't. So by nature, debt contracting is way safer than equity contracting. Therefore, return on debt should be naturally lower than return on equity. Well, now in the perfect world, when you increase the amount of debt, you rely more on cheaper source of capital. But as you increase the amount of debt, the return on equity will increase. And in a perfect capital market, the increment in the return on equity will be exactly offset by the use of cheaper source of capital, the debt. And then the overall expected return on the firm's asset, represented by the firm's WACC, will remain constant. It will not change. It will not be affected by the firm's capital structure choices. Okay, so this one graph is one of the two slides that I want you to take home today. Okay, so if you are a little confused by all mathematical and numerical explanations, keep this graph in mind. Okay, this is how the bunch of different expected returns move in a perfect world. Okay, so in a perfect world, as the debt to equity ratio increases, cost of debt doesn't change. Cost of equity will increase monotonically, but weighted average cost of capital at WACC will not be affected and remain constant. Okay, let's now summarize what we have learned so far. So M&M Proposition 1 says a firm's leverage does not affect its value, total firm value. In terms of the firm's cost of capital, the firm's WACC will not be affected either. So M&M Proposition 1 says the capital structure does not affect firm's total value or its WACC. And M&M Proposition 2 says the expected return on equity increases as leverage increases. In other words, in a perfect world, if the company uses more debt, the expected return on equity will increase. Well, isn't that confusing? Because M&M proposition 1 says, according to M&M proposition 1, we do not lose anything by increasing the use of debt, by increasing leverage. But when the company increases its leverage, the use of debt, the expected return on equity does increase. Well, then isn't it an absolutely good thing? And we should go for the 100% debt financing, because the more that we use this, the higher the return on equity investors. And we don't lose anything in terms of the total firm value or overall cost of capital. Well, if somebody makes that argument, what that person is missing, well, or foregoing, well, what's behind the scene, what's happening is the risk to equity holders. So if somebody made an argument, as I made previously, then this person was foregoing or ignoring one of the most important aspects of investment, the risk. Okay, so it's true that when in the perfect capital market, when the leverage increases, the firm value is not affected, but the expected return on equity holders does increase. But there's one more thing that is increasing with the use of leverage even in the perfect world. It's the risk to equity holders. Actually, the reason why expected return to equity holder is increasing is just because the risk to equity holder is increasing. Well, the finance 101 is there's no free lunch. To earn higher return, you always have to embrace higher risk. Or in other words, to make someone embrace higher risk, you have to always offer higher return. That's finance 101, okay? So what's happening behind the scene is the risk to equity holder is also increasing. Well, intuitively, that's a sure thing. Well, recall that equity holders are residual claim holders. And payment to debt holders always made first before anything can be taken by equity holders. And the more amount of debt the company uses, the more amount of interest obligation the firm is facing. The more amount of cash has to be paid first before anything can be left and paid to equity holders. So by nature, as the company increases the amount of use of debt, less amount of cash will be left available to be paid to equity holders. Therefore, by nature, the use of debt will increase the risk to equity holders. Well, we can define, actually, the way that the risk to equity holder increases is specifically defined. I have no interest in going over all the mathematical proof, but I want you to remember this one equation, okay? So it's almost parallel to the RE equation. So just like the return on equity is increasing with the leverage in perfect market, the risk to equity holders is also increasing proportionally and monotonically to the debt to equity ratio of the company. So I want you to remember this equation. So summarizing the outcome of the M&M propositions and theory in perfect world. So in a perfect world, the value of the firm is not affected by the firm's capital structure, and it is independent of the firm's capital structure. In other words, we say a VL equals VU. Well, in terms of overall cost of capital, the firm's WACC is not affected either by the firm's capital structure. So we say that firm's WACC is always remaining the same at the RU level. So our WACC equals RU. Well, but even in a perfect market, there are two things that do change, which is the return to equity investors and risk to equity investors. So they are going parallel. The reason why the return to equity investors is increasing is just because the risk to equity investors is increasing as well. And the specific relationship can be defined by the M&M proposition 2 equation. Okay. All right. So what is the implication of the M&M capital structure theory? So M&A capital structure theory, perfect world version says the firm's overall value or overall expected return is not affected by the firm's capital structure. So we say that the perfect world version of capital structure theory is the capital structure irrelevant theory. Capital structure doesn't matter in a perfect world. Well, what implication does it bear? Well, before we ponder upon the implication of the theory, let's revisit the perfect world assumptions. So we define the perfect world as the world with no taxes, no bankruptcy cost, no transaction cost, and the world where firms and investors can borrow and lend at the same rate, and the world with no information asymmetry, and the world with perfect competition. While looking at each of the perfect world assumptions, very few of the assumptions, if any, hold true in the reality. Well, what does that mean? If any of these assumptions does not hold true, then this nice and beautiful outcome may not be achieved. Well, but there's a very good chance that, and very high chance that the perfect world assumptions won't hold in the reality. What does that mean? What's the point? Did we just waste our valuable time to learn something that would not be relevant in reality at all? Did Monica and Miller receive the Nobel Prize winning? Did Monica and Miller win the Nobel Prize for the development of theory that has no relevance in reality? Well, hope not. So what's the next step? Actually, the beauty and the whole point of M&M theory is not predicting our reality, but it is in saying and telling us when capital structure choices can matter. Okay, so putting in other words, well, perfect world version of the M&M capital structure theory says if tax exists, it means that capital structure may matter. If bankruptcy cost exists, then capital structure may be very important and it may affect the firm value, etc. Okay, so the beauty and importance of the perfect world version of the M&M capital structure theory is in telling us when capital structure choices can matter. In other words, what factors and considerations can affect the capital structure choice and the firm value relationships. And the theory is guiding us the considerations and factors that financial managers have to keep in mind when they choose the firm's capital structure optimally. Because in reality, all those imperfections do exist, right? And in other words, it means that we have to keep the tax in mind. We have to keep the bankruptcy costs in mind. We have to keep the transaction costs in mind when choosing the optimal capital structure for the company, because those factors will affect the relationship between the capital structure and the firm value. Okay, so if tax exists, then capital structure may matter. If bankruptcy costs exist, then capital structure may matter, etc. So from now on, next time, we are going to relax some of these perfect world assumptions one by one, and then we will make our model one step closer to the reality that we are living in. And then, starting from the next time, we are going to see that capital structure start to matter. That's the end of the lecture for today.